The cash flow analysis shows the flow of money in and out. It can form part of both valuing the risk and potential in one's own company as well as before investment decisions in other businesses are made. The following video goes through the cash flow analysis step by step with the indirect method. Step 1. Operating activities, which can be explained as the very basis of the daily activities and consist of the main revenue generating activities. Step 2. Investing activities, the accumulation or sales of fixed assets. Finally, Step 3. Financing activities, which consist of the transactions made in the business between the owners and potential lenders. First up in the operating activities is net income. By first adding all the business income and subtracting all the cost, an operative result can be established. This is before the deduction of interest and taxes, and therefore also known as EBIT or earnings before interest and taxes. Adjust the operative result by adding financial income in the form of, for example, dividends and interest income. Finally, remove the financial cost from the operating profit, the borrowed capital, and what remains is net income. The second part is adjustment for items that do not affect the cash flow. In this category, start by adding depreciation. For example, this could be for a truck that the business has purchased. Since the expected life, in this case, is calculated to be 5 years, the entire purchase should not be charged to the result as cost in year 1. Thus, the cost is divided into 5 equal parts and portioned out over 5 years, where each year's cost is added as depreciation. Then add devaluation. This can be an adjustment within, for example, a property where the real value has fallen by 10% concerning the book value. Subtract capital gains. Capital gains occur, for example, when a house has been bought for a lower price than it was sold for. The difference is the capital gain. Add capital losses. As opposed to capital gains, these arises instead when the house has been bought at a higher price than what it was sold for. Finally, changes in provisions must be adjusted for and will be the last part of the calculations needed to sum up the adjusted cash flow. The third part of the indirect method is paid income tax. With this part, adjustments are first made by subtracting input tax liability and adding output tax liability. Either add or remove the current tax from the income statement. Finally, add the opening balance OB tax receivables and subtract closing balance CB tax receivables. Only income tax then remains. These 3 parts are then added together and form the cash flow from operating activities before changes in working capital. The fourth part to calculate within the operational cash flow and the first within changes in working capital is change in inventories. The calculation is relatively simple, and the change is calculated by first adding the closing inventory balance and then subtracting the opening inventory balance. The fifth part is change in short-term operating receivables. Here, in this category, start by adding the closing balance of accounts receivable and subtract the opening balance of accounts receivable. Example of receivables can be an invoice that has been sent to a customer for work performed but which has not yet been paid. The sixth and last part that must be adjusted for in the operating activities is change in short-term liabilities. Begin with adding the closing balance for current liabilities while removing the opening balance current liabilities. A company's operating debts can, for example, consist of a debt to a supplier in the form of an invoice, which has not yet been paid. After these last 3 parts are corrected, the adjustment of cash flow from operating activities are done. Thus, the first step of 3 has been examined to finally complete a business complete cash flow analysis with our indirect method. Based on step 1, step 2 follows, which concerns the investment activities. All potential acquisitions and sales of fixed assets are examined here. The process for calculating and checking whether the business has acquired any fixed assets is the same for all 3 items, for acquisition of intangible, tangible, and financial fixed assets. The acquisition of fixed assets is examined by adding the opening balance of the asset to be investigated. That is, by choosing one of the 3 different assets, either intangible, tangible, or financial fixed assets, and adding the entering balance. The next step is to subtract all depreciation for each asset, meaning the systematic reduction of assets' value over time. After that, remove any potential write-downs. It happens when assets, their acquisition costs, are revalued with a negative amount. Add potential appreciations or increases in assets value by revaluation, if such a revaluation has been made. Subtract the book value of assets that have been sold. Finally, subtract the closing balance for each fixed asset. What remains is the sum of the year's investment for each asset. The third and last part of the cash flow analysis represents the disposition of fixed assets. It is a similar process as the one before when investigating whether any acquisition of fixed assets have been made within the investment activities. Within the category of disposition of fixed assets, the calculation and control of whether any sales of intangible, tangible, and financial fixed assets have been made during the period are examined here. The disposition of fixed assets is examined by comparing the book value of sold assets against a potential capital gain or a capital loss. For example, if an asset had a book value of 2 and a capital gain of 1 was made, the sum of 3 should be added to the sales regarding cash flow of that item. Likewise, if for example an asset had a book value of 4 and instead a capital loss was made of 1, the sum of 3 shall be added to that asset item in the cash flow. When these 6 parts are checked, they can be summed up and together show the total cash flow from investment activities. After step 2 is done, finally, step 3, the financing activities, and the last step are calculated. The part accounts for how money comes into the business or disappears from it, based on, among other things, changes in indebtedness. The first part to investigate is whether the business has made any new right issues. So, if the company has brought in some new money by offering, for example, the public or existing shareholders the right to subscribe for new shares. This is done by adding the contribution of share capital. The capital is calculated by comparing the quota or par value, which is share capital to the number of shares, and multiplying the number of new shares that the business issues or gives out. Since the payment for a share might not be lower than the previous par value, but may exceed it, the potential higher payment constitutes a premium or an additional paid-in capital. This sum is not included in the share capital of the new issue, but is instead moved to premium fund. The share capital of the new issue plus the premium fund together form the additional equity capital. The second part of the cash flow from financing activities is change in notes payable. In the category change in notes payable, start by subtracting the opening balance of the loans. The loans can be long-term, which means that the debt is due for payment after more than 1 year, while the short-term loans are due for payment within 1 year. Then add the closing balance for long and short-term liabilities or loans. The closing balance for loans, together with the opening balance loans, constitutes a net change in loans. Finally, add amortization, which is the repayment of the loans, to the sum of the loan's net change. The remaining value shows if the business has taken out any new loans for the period. The third part of the financing activities is the amortization of loans. The category amortization of loans does not even need any calculation. It can be read directly from the balance sheet. Amortization of loans is equal to the opening balance of short-term loans. The fourth and last part of cash flow within financing activities is dividends paid. The category of dividends paid investigates the outflow of capital or return to the business owners. Capital that can be used for dividends mainly consists of balance result, the sum between profits and losses from previous years, with deductions from previously made dividends. It can also consist of the year's profit, or that, for example, when shares in subsidiaries are distributed instead. The capital is distributed to the owners and become a form of reward or return to the owner's invested capital in the business. Taken together, these four parts show the total cash flow from financing activities. Thus, all steps are calculated and checked for in the cash flow analysis. What remains is to sum up these three steps. The period's cash flow then becomes the sum of the positive or negative change in step 1, operating activities, step 2, investing activities, and finally, step 3, financing activities. Finally, the incoming cash, which is found in the balance sheet, can be added to the period's cash flow and together form the outgoing cash for the period, or in other words, liquid assets at the end of the year. For more videos, please subscribe. If you like this video, make sure to check out the next one. Thank you.